Welcome to the Dakota Research Podcast. This podcast is for informational purposes only and should not be considered investment, legal, or financial advice. The views expressed are those of the speakers and do not necessarily reflect the opinions of Dakota or its affiliates. We do not provide investment recommendations or solicit investments in any securities or funds. Listeners should conduct their own research before making any investment decisions. Hello, everyone, and welcome back to the Dakota Research Podcast. This is the 6th episode. It's been a lot of fun now, over a month. Can't believe we're already into March. Spring is right around the corner. Very exciting stuff all around happening at the firm with Dakota Research growing every single day. Portfolio company data being added really soon. Public company data and earnings calls being added really soon. We'll talk about a bunch of stuff today. And again, as a reminder for our listeners, everything we go through on this podcast, you can find within the Dakota Research platform. That's the source for all this data. And it continues to be a powerful source for wealth managers, endowments, foundations, pensions, and consultants. So without further ado, I'll get into the agenda for today. As always, we'll kick it off with some fundraising highlights, key deals, and people moves. Today, our topic deep dive discussion will be lower middle market buyout. Feels like it's an asset class everyone's talking about, so I want to make sure that we discuss it. Who are the key players? What's the wins look like? How should you think about the asset class? Then we'll talk about upcoming events, show notes, and Q&A. We do have interviews today as well as last week. Very positive feedback from last week. Today you'll be hearing from Eden Capital. They're a leader in the lower middle market buyout space, so very excited to be bringing them to our audience. If you want to be interviewed, reach out to us. You know where to find us. Without further ado, we will kick it off, and don't forget to enter any of your questions in the chat box below. Great. Alex, why don't you kick us off here with a key fund launch with Ares and Millennium involved?
Yeah, so former Ares head of special situations and co-head of the private equity group is launching his own firm called Lane 42. This is receiving a $2 billion backing from Millennium. This is not the first time Millennium has backed other asset managers. Even in just the last few months, a couple I'll list off here. Millennium has backed Scopia Capital, as well as two former Kepos Capital PMs with $1.8 billion in November. They backed Robert Tao's firm with $1.5 billion in December, along as other backings of asset management firms. So this is not new for Millennium to sort of back these new investment firms or PMs spinning out to start their own projects. So Lane 42, investing across public and private debt, sector agnostic, and they're really looking to target companies across stressed and distressed situations, as well as companies that are healthy as well. So really just being very opportunistic across the spectrum of credit investments and asset, public and private investments. I was reading in a Bloomberg article that Lane 42, the creation of the name, Graves' middle name is Lane, and 42 is cited as the answer to the ultimate question of life, the universe, and everything in The Hitchhiker's Guide to the Galaxy, which is a series of science fiction books. So,
have you read them?
Of course not.
Oh, maybe of course not, dude. I've read the first one. It's incredible.
Oh, really?
Yeah, Hitchhiker's Guide is unbelievable. They made a movie out of it. It's great. It's a legend.
I think, too, with this announcement, you have Ares, which is such a dominant investment firm within the private credit space, too, one of the largest players. The backing of Millennium to help Scott start out with a new investment firm. You just think about the market opportunities today, too, just being one where there's been sort of steady up and to the right. Now there's a lot more dispersion, a lot more volatility in the markets, interest rates kind of changing by the day, and the path of interest rates changing, also where we are in the cycle too as well. So having the flexibility to kind of adapt and go, both public and private, I think would be a really interesting setup to be able to capture different alpha opportunities in the market.
Yeah, absolutely.
Yeah, and that's an official Dakota Research recommendation for anyone to go and check out the Douglas Adams novel, Hitchhiker's Guide to the Galaxy. I have only experienced the first one, but I'm sure they're all great.
We have another private credit announcement too, as well, coming out of Wellington. Wellington launched a private real estate credit platform with an ex-PIMCO team. They said that on last Wednesday. It was expanded its private investment offering with the launch of a private real estate credit platform. They hired 4 former members of the commercial real estate debt platform at PIMCO to oversee this new platform, with Ravi Anand named as the head of the private real estate credit team. They'll be based in New York. Wellington, obviously, based with teams globally, but well established in Boston. Yeah. But this team will be in New York. Also, the PIMCO team, have this large West Coast presence too as well. So the team will primarily focus on origination of senior and subordinated loans across North American property sector, with the possibility to expand global markets. I think, again, on the private credit side, we think about real estate today, where real estate is in the cycle. We kind of talked a couple weeks ago about Apollo buying Bridge, the origination factor too. But I think you're seeing more sort of unthawing within the real estate market, people seeing it more as an opportunity to invest through. Real estate credit being one interesting starting point to invest in at this particular point in the cycle versus equity. There's structure, around it. There's the asset class collateral, from the real estate itself, but there was also, mispricing too as well, and the ability for this team to go out and, price deals at advantageous pricing. So more to come there. We'll watch this team build out further, but obviously kind of a marrying of, the PIMCO team, the DNA there, and credit coming over to Wellington. So more to come.
All right, moving right along, we'll talk some fundraising highlights. We have one with CVC. You'll run us through, Alex, and then we'll talk a little bit about Garnet Station. Actually, just read an article about them. I think it was 2 days ago in the Wall Street Journal.
Yeah, so CVC, they closed their Strategic Opportunities Fund. This was their third vintage. They received almost $5 billion in commitments, and this was matched and sort of succeeded the previous fundraise. This is an interesting strategy. So again, today we're going to talk about lower middle market buyout. This is a little bit of a different strategy. They're targeting companies with enterprise values between 1 and 5 billion. So definitely on the larger end of the middle market for sure. They're not just making buyout investments. They're taking control, co-control, and minority investments as well. They try to emphasize longer holding periods as well. So 6 years, almost up to 15 years. They really look for companies that are generating cash in non-cyclical industries. So a unique strategy for sure, and a company and a firm that has multiple investment platforms as well. They have a credit strategy as well as other private equity strategies. So interesting firm to follow, interesting strategy. Curious to follow it going forward.
I think, CVC obviously based in Europe, but you classify them, with the largest, most dominant, mega private equity firm. CVC is a listed, it's a public firm that's listed as well. But definitely a trend that we've been seeing more and more of as these firms continue to expand their capabilities, the market size grows. Their flagship fund obviously focused a lot more on the larger deals in the market, but having this Strategic Opportunities Fund with the ability to take advantage of what they're seeing at the middle market opportunity. So we saw this with KKR. We saw this with some of the other firms too as well, where they've recently wrapped up fundraising closes for their middle market specialty funds as well. So I think CVC too, when you think of them as a firm, they have this long heritage of buying, founder entrepreneurial led businesses, and that just ports really well over to the middle market opportunity set. In addition to that too, you mentioned the longer hold periods as well. I think that is true too. When you think about their flagship fund and some of the businesses they've been able to build and add value to, their holding periods tend to be longer, but then you also that shows up well in their returns as well. So while some people might think, they take a little bit longer to develop or things like that, but they're compensating that in form of return. So
yeah,
something to keep an eye out for too, but well-known firm there for CVC.
Yeah. Well, moving on to Garnet Station, if you're not familiar with the firm, again, there was just an interesting article last week in the Wall Street Journal about them. It's a cool background. The firm in 2013, two younger gentlemen considering for the industry that were friends started buying Burger King chains. They bought 23 distressed Burger King franchises, and now they've created what, for lack of a better word, is a giant private equity firm. So Chris, tell us about what they're up to now.
So I love this story too, because it is a great story. Two friends coming together, both exceptionally talented in their own right, but being able to work with your best friend, I think that's got to be an interesting dynamic too, and make it work every day with giving the the daily demands of working in investing in private equity. Garnet Station, this was their fifth fund. They closed at 1.2 billion. Their predecessor fund closed in 2023. So step up from there. That fund closed at 850 million. The AUM for the firm now stands at 3.5 billion. So when you think about the dry powder, the firm, the expansion of that platform itself, that means that they have scaled up further, and they have a lot more ability to kind of make deals and expand kind of the areas where they're focused on. But you mentioned Burger King. They have a very specific focus in multi-site operating models. So you think about Burger King franchise model, multiple sites, they have the real estate, but then there's the big operating component as well too. And one of the things we've been talking about a lot too is Garnet Station's been a big player in car washes. At first phase, I'm like, why would anyone want to be interested in car washes? But they're high cash generative businesses. There's the real estate component as well, but there's also a large benefit to both scaling to multi-site operations and embedding technology within these. There's so much new technology that are coming out in car washes specifically, and these guys are one of the specialists. I believe what I read was one of their platforms is actually based out in the West Coast, I think Las Vegas specifically, where they have a platform investment there. And you think about better weather, having more people kind of coming there on a day-to-day basis versus the Northeast where we have, more seasonality and things like that. But Garnet Station, definitely a firm to follow. There was a quick turnaround in terms of fundraise, obviously strong participation from existing LPs too as well. So I think we'll continue to see more from this firm as they continue to move higher in terms of within the market.
Yeah, especially in the environment today, the fact that they were able to close an $850 million fund in 2023, deploy probably most of it, and then need to raise another one and close it at over $1 billion in just under 4 months is pretty wild, and shows that even in sort of this weird market that we're in right now, they've been able to deploy capital efficiently.
Yeah, and I think too, what in coming back to the areas they focus on, I think it speaks to investors really getting comfortable with the areas they're deploying capital to. So from a sector perspective, that's consumer, business services, areas of the market that are a lot more resilient, despite where kind of the market is. Health and wellness, I mentioned automotive, the car wash businesses. I think they also have exposure to mechanics, servicing, things like that, and then food and beverage as well too. So more resilient parts of the economy that are not as sensitive to kind of consumer discretionary cycles or wealth effects or things like that. Things that are a lot more economically resilient too as well.
Great. We'll transfer over now to our deal announcements side. We haven't spoken about one of these yet, but there's been a notable take private. It's happened by Sycamore Partners with a company that everyone listening to this is no doubt familiar with.
Yeah, I think this is an interesting story too, and probably has implications to maybe a Walgreens that we, visit on a daily basis. The market is very moved to much more of an oligopoly model. You have CVS, you have Walgreens. Rite Aid is not as competitive and
remember Happy Harry's.
Happy Harry's too.
That's good stuff.
Absolutely. So Sycamore Partners is well known for buying these complex situations. And when you think about Walgreens, you have the pharmacy business, they have, the cosmetics, they have the other, retail facing components to it as well. And they have kind of the daily needs element is things. But when you think about too, some of the intertwinings of how this industry's changed, Walgreens has found itself in a much more difficult environment. This is another notable take private transaction too. So Walgreens being a publicly listed company, now going to be taken private by Sycamore. Total value of the transaction represents up to $23.7 billion, so notable too. So we've seen a lot of sort of these dislocations of the public market, private equity stepping in to take the company private. There's a lot of moving pieces with this business too. And while this is our sort of daily needs, there's a lot of potential there as well. There's also complexity around this deal that Sycamore has to sift through. So more to come there. The company will continue to operate under Walgreens boots and its trusted portfolio of consumer brands. WBA will maintain its headquarters in Chicago. We'll continue to follow this story, but notable nonetheless at the size of the deal.
Yeah, and I'll wrap up this segment too. I'll jump over to San Francisco. Francisco Partners is set to acquire Quorum Software. They're acquiring them from Thoma Bravo. Francisco Partners announced this very recently. If you're not familiar with Quorum, I was not prior to reading over the script you guys put together this week, but they're a software provider for digital transformation in the energy industry. Says they're powering growth and profitability for energy operators by connecting people, workflow, and systems with decision-ready data.
Wow.
Still don't know what they do, but no doubt it's a great business. They have 1,500 customers ranging from energy operators to global super majors across 50 energy producing countries.
I think another notable point too here is that obviously both these firms are considered the blue chip software investment firms in the market. And this is a sponsor to sponsor type transaction. So one private equity firm selling to another private equity firm. And when you think about Thoma Bravo and the ability for them to add value for the investments that they make at the operating level, they have so much ability to kind of add customers, reorganize the business, make those businesses a lot more profitable, position them for an IPO or acquisition to another strategic. It makes you wonder what Francisco Partners is going to add from a value perspective. So perhaps, and we have to look more into this too, but it's likely that they've invested in the space before. They know it well. They have other customer relationships they can probably bring to bear on this transaction, in addition to possibly positioning the company further. I don't know what fund Quorum Software was held into, so it also could be a timing thing, simply where Thoma Bravo has realized good value in the business and is ready. It's the right time in the cycle where there's an ability for Francisco to kind of capture that next leg of the cycle in the energy markets.
Yep. Yeah, speaking of cycles, we're approaching the end of the quarter, so we do tend to see some job and role changes, some turnover sort of cycling. So moving over to the people move segment here, Chris, tell us what's going on at the wealth management division of Schroders.
Yeah, absolutely. And this is a notable development. Schroders, they announced the appointment of Oliver Gregson as CEO of its wealth management business. This is effective June 2nd, 2025, pending regulatory approval. He will join the group executive committee and report to the group chief executive, Richard Oldfield. He will oversee Cazenove Capital, Benchmark, and Schroders Personal Wealth in the UK, and lead the expansion of the firm's wealth business outside the UK to establish a global presence. Oliver, industry veteran, 25 years experience spanning wealth management, private banking, and asset management at notable firms such as JP Morgan, HSBC, Barclays, UBS, Citigroup, to name a few. So more to come there, but a notable change nonetheless.
Yeah, another sort of thing we want to call out, also in the wealth side, you have the former chairman and managing partner of Genstar is launching his own family office. That is Jean-Pierre Conti. The family office will be called Lupine Crest Capital. They're going to be headquartered in Aspen, Colorado, and they'll be focusing on private equity, real estate, and venture investing. On that side of things, they're intending on investing in companies that have revenue between 50 and 500 million, pretty wide range there that he's looking at. Conti is the chairman and managing partner at Genstar Capital. He's been with the firm for over 30 years, and he led acquisitions, divestitures, and oversight of all portfolio companies. So no doubt he is poised to grow this family office handsomely.
Well, this is a really unique headline too. It's actually part of a broader trend that we're seeing go on, and the kind of blurring lines of private equity and family offices. And the family office universe continues to expand, but they also continue to get a lot more sophisticated. Years ago, family offices, a lot of these individuals kind of map or mirror what a lot of was going on in this story too. And today, this is continuing to be a repeating theme, where you have deal professionals at private equity firms that are very comfortable investing in direct deals, setting up family offices to continue that, and then bringing in external capital in some cases. We've seen it with David Rubenstein at Carlyle, who's opened his own family office to do just that, and also he's very heavy in real estate. Now he's done a lot in kind of sponsoring managers that are very asset class focused or specialists within a specific sub-industry in real estate. We've seen this time and time again. So it's really interesting because I think these individuals are very accustomed to seeking high returns. They're comfortable investing in the private markets. They can deliver solutions for their own personal wealth, and sometimes also bring in co-investors too as well to deliver, a very interesting family office wealth solution that is not replicable inside maybe a bank or other wealth management division elsewhere.
Yeah, it gives Conti much more bandwidth and flexibility to make investments and be a lot more nimble than maybe operating under a private equity firm.
Great. Now we'll move over to our topic deep dive segment. Again, today we are going to be talking about lower middle market buyout, and you will hear from Eden Capital throughout. Let's kick it off. Alex, why don't you just give us a quick sort of overview on lower middle market?
Yeah, sure. So I'll set the stage very briefly and sort of define what the lower middle market is using some numbers to give people a range. So if you think about in terms of ownership structure, these are privately held companies, mostly family owned, regional focus in niche markets, right? Maybe one or two offices, very niche focused, only operating in certain areas. Again, generally not regional or national big brands. We're thinking about company size, generally with enterprise values under 100 million, and then revenues ranging from around $5 to $50 million a year. If you think about just the fragmentation of the market too, over 90% of PE targets in North America are in the lower middle market. So the market is massive. And really, compared to the larger end of the private equity buyout space, it's a lot less players and probably some less competition relative to the market size. If you think about sort of like the transition and succession planning within these founder-owned companies too, more than half of these businesses in the lower middle market, they don't really have a succession plan. So PE firms coming in and providing liquidity while introducing professional leadership, governance, operational, technological innovation is a huge benefit to these businesses looking to expand.
Yeah, when I think about the lower middle market, what's so interesting too about that investment opportunity set specifically is we think about the vast majority of businesses in the U.S., Main Street America, small business. You just go a leg up about that and you think about how many businesses there are in that universe. These are owner operators, maybe first generation business owners, maybe they're multiple generations of business owners within a specific family, doing one thing very specifically. And when you think about the profitability range or the revenue range, Alex mentioned 5 to 50 million on the on EBITDA range between 2 and 15 million. Those are small businesses relative to what's going on in the upper part of the middle market and the larger end of the middle market too. And there's so much to pick through, and there's so many of these businesses out there. And because they're less institutionalized, there's a lot of value. And I know Eden Capital is going to speak to that in a moment about how they add capital and specifically defining the lower middle market as they see it. But it's just an exciting opportunity also because of the investment return potential too that private equity can bring to bear when you think about a founder transitioning. Maybe it doesn't have another family member that is going to step into the business, take it over, and so they're thinking about their 5-year plan, their 10-year plan for what they're going to do with their business that maybe they started, maybe their grandfather started, maybe their father started it. So there's this heritage aspect to it as well, but then there's ability, and if they're in the right and attractive market, the ability to have an infusion of capital and the operating capabilities to really make these businesses 2 to 4 times to 5 times better. So I know we're going to listen to Eden Capital now, talk about their perspective on the lower middle market and the opportunity set there. But I think it would just help to share that for context too as well.
Yeah.
So how does Eden define the lower middle market specifically?
So for us, the lower middle market, we're investing in companies with 3 to 15 million in EBITDA. So it's important that they already have a business model and some earnings that we can base the business on. And that discipline has really helped us in times of crisis, like when COVID happened. Some of our positions obviously had to dip into their earnings to make it through, but thankfully we're able to double down, and they've all done really well even through those outside unexpected shocks.
And we hear a lot about it too today, specifically about lower middle market being a really attractive place to invest. Can you speak to a little bit about what makes this segment of the market, attractive? Obviously, there's smaller businesses that are kind of on their way to becoming more institutional, or maybe they're founder-led. So just kind of would love to hear your thoughts around that.
For sure. So the lower middle market in particular is a target-rich area where there are a lower number of funds and a lot more opportunities. If you just think in that size range of 3 to 15 million, there are a lot more companies that make it to that size range. It's really scaling from there and going up that is a big challenge that we're now helping our companies bridge the gap. And then bringing our expertise, working from larger private equity firms, we know the road ahead, and so we can help them through that journey. And again, our operating partners are a key partner there to take them into the next size range, into the mid-market and beyond.
So there's a lot of opportunity and a lot of businesses to evaluate and select, but then also having that reference point as well, based on you and your partner's experiences working at larger firms. Exactly. And being able to bring that level of expertise to it, plus the operating partner network, is a really nice advantage to have, I'd imagine.
Yes, and you have to think of our period of ownership as a really transformational period for these companies.
Absolutely. Why does lower middle market matter, I guess, is one question that people might be asking too. So as we mentioned before, the lower middle market represents the vast majority of businesses in the US. Thus, it's an important growing part of the market, and it's highly inefficient. Thousands, hundreds of thousands of businesses out there to pick through for private equity firms. But there's also a mismatch. The majority of capital of private equity sits at the top end of the market, chasing fewer deals, where dry powder available and the number of firms chasing all these other ones is far less. So it's almost like an inverted pyramid when you think about it. Why the lower middle market is attractive from an investment perspective? Several factors to consider that make this an appealing investment space. We talked about a little bit about returns. When you think about back in the day, on the larger end, mega buyout, large buyout, these areas were able to deliver high teens, low 20s type IRRs and a decent multiple on money, respectively. But as you think about the market and over time, how they're creating those returns have changed. You think about interest rate environments, you think about the size of these businesses, you think about how much more value can be kind of created, sometimes less operating levers that you can pull to drive outsized returns. In the lower middle market, it's the opposite. Importantly, a couple key points. There's a value arbitrage and lower entry multiples for these businesses too. So when you think about lower middle market companies, they typically trade in kind of the 6 to 8 times EBITDA range. On the large end of the deal, depending on sort of the cycle and where things stand, those multiples can be 10 times or greater. If you think about like a software business or something like that, if it's on revenue, it could be much higher than that in terms of profitability. You know, these sort of upper, perfectly teed up quality businesses trade at a much more premium because of their inherent profitability and attractiveness and recurring revenue. But in lower middle market, there's a big discrepancy between the valuation spread between what you see in the large end of the market. There's also the potential for multiple expansion and significant returns because of institutionalizing the business, making them more profitable, and then exiting them at a higher multiple that another sponsor might be willing to trade. The market's highly fragmented, and so the big driver of the playbook often, and Eden Capital gets into this a little bit, but buy and build opportunities and what that means. That could be buying a specific business as a platform acquisition, and then tucking in or adding on businesses that are smaller to increase revenue or profitability. Add-on acquisitions allow for increased efficiency, pricing power, and also to gain market share. And then the PE firms allow the business to scale that way too. We're going to turn to Eden Capital to hear a little bit more about their value creation playbook. And you mentioned value creation playbook. So upon closing a transaction, you move past that. Talk to me about the value creation playbook that Eden applies to every portfolio company.
Our value creation playbook is structured around 5 key areas: the governance and the board, the talent and management team and the work around really creating those roles and responsibilities, sales and marketing, finance, and M&A. And so I can walk you through all of those, and it's important to realize the amount of work that's required from these companies to work through all of these. So first, when we come in, we're often the first institutional capital, and these companies don't have a board. They don't have anyone they're reporting to. They're founders that have taken the business from A to B and then need help getting from B to C. And that's where we come in. And so we bring the operating partners. We have 2 members of the Eden team that sit on the board and help the company and start creating that governance. If you've got to report quarterly, I mean, obviously we're getting financial reports monthly as well, but that big package of thinking about the different areas of the business and having that conversation at that higher level with the board is a big change for a lot of our companies because they haven't had that level of accountability. When you're sitting on your own with your team and you say, okay, next year we're going to double revenue, if you don't put it on a piece of paper and actually hold yourself accountable and sit at the end of the year with the team and with the board, okay, we said this was the plan, but we're nowhere near. Timelines slip, right? And you've got reasons why this didn't happen. And, and so it's easy within a founding team to let the timeline slip. And I think that's something, that accountability is really hard when we come in, we say, okay, you said, and this is what's happened. So where's the rub, right? Let's work through this. And so there's certainly an adaptation period on that accountability piece. The second is management. When we come in, it's a founding team and all the threads are coming into the founder. And everybody's wearing multiple hats. You're running and fixing the lights one day and speaking to large customers the next. I mean, you're doing everything, right? And that's the joy and the beauty of entrepreneurship, but it's also the challenge as you want to scale because you become the limit to the business. So we have to come in and bring these functional experts that come in and say, I'm going to hold marketing. I'm going to hold the B2B customers. I'm going to hold customer success and start creating that specificity in the roles and responsibilities. So when something goes wrong, it can't be, oh, well, it's always the CEO, right? The CEO has to have their role and manage the team. And then under that, we have to staff those key roles behind them. And so you'll see us on almost every deal bringing in marketing, sales, content, technology, finance. And so we're revamping that team and bringing some of the key players around that founding team.
And just on bringing the critical resources internally there, so hiring the C-suite and bringing in senior executives to the organization, is that something you're doing directly, or are you positioning somebody internally to kind of lead that process?
Most of the times, just given the size of the companies, we're leading the searches. And in particular, when it's a CEO or CFO search, it's certainly our language. If we have someone that is willing to take the search on for marketing or sales, we're more than happy for them to run it. But what we find is they often want us to run through the interviews and then come up with 2-3 candidates that then the founder will select the best cultural fit from. And so we've done that a couple of times, either from our team at Eden, or they'll ask someone on the board, hey, you had a business that had a lot of depth in marketing. Could you help me find someone? And I'll come in for the last round, right? And so it saves them an incredible amount of time. And you've got someone that can ask the right questions, that can vet the right marketing lead, and then present them to the CEO and empower them with this person that's got all these skills that the company didn't have before. So we do, our operating partners do, and then sometimes when the company wants, they'll run those searches.
And there's two things what you're saying there too that are so interesting too. Is one is about sort of like a reset in terms of goals, objectives, and also separating those prior responsible duties of all just being on the CEO or entrepreneur founder,
right?
Putting a process in place, but then also having a level of trust with the people that you're putting in those positions too, and being directly involved in that for alignment, accountability, et cetera. So from a benchmarking standpoint, you can achieve kind of desired outcome. And, in addition to that too, just having those people, I guess, come from within the broader Eden network too, there is a level of trust there. That's really important, because making hiring decisions this is high risk. There's a short time window to execute within your value-added playbook, and any kind of friction there, I would imagine, can kind of disrail things.
Very well summarized. And in fact, we had the whole team at Eden go through the GH Smart training for hiring, and they tell you on day one, 50% of your hires are going to be wrong.
Wow.
So I mean, exactly. It's a huge friction in any role, right? That even with all this work, even with all this vetting, some things are just not going to work out. And so it's important to come to this with a level of humility and understanding that what worked here might not work there, right? And there are a lot of factors that go in. But certainly, to your point, having that network of operating partners that we know we've worked well with before and we've seen their capabilities in action certainly helps take a big part of that risk out. So the last 3 areas of value creation that are important to us is sales and marketing. The founder is usually the person going out in market and getting the word out on the business. We start employing sales and marketing teams to go out and build that go-to-market engine. In finance, when we come in, it's usually just a controller, if that. And so bringing in the CFO that will start putting all the dashboards in place so that the leadership team can see what the levers are in the business that they can pull, where they're doing well, where they can add more capital and accelerate the growth is really important internally. And then it's really important at the board level. And obviously for private equity, all those reporting packages that come back to us. And the financing as well, our financing partners and the requirements there. And then finally, last but not least, M&A. M&A is a big component of what we do when we come in. The businesses are between 3 to 15 million EBITDA, often in fragmented industries. Having that tool and being able to bring on one platform different areas that you can put under one business where they can benefit from that best-in-class marketing, best-in-class sales, and technology that we've built really creates a big engine for some of these companies that could not afford them if they're at a couple of million in sales. And so the platform really powers all of these add-ons, and it's a big tool for us also to average down our entry multiple. And so for value creation, it's a really interesting tool for Eden.
Thanks to Eden Capital for going over their value creation playbook, but just kind of recapping some of the stuff they talked about and just how value creation works in the lower middle market buyout space, thinking about what these firms can do. So I think the big one is operational improvements and technology upgrades. Again, these are very small businesses, and a lot of them still rely on reporting using Excel or very obsolete technology to run their business. So that's very low-hanging fruit for these PE firms to come in and improve how the business is run, and that can greatly improve the bottom line as well. So technology, operational improvements, that's a big way to drive value of the business, and hopefully a few years down the line exit at a higher multiple.
Yeah, in addition to sort of the technology aspect of it too, when you think about on the people side, which Eden Capital talks about, it's a lot about where the CEO, the founder, the managing partner of the business, they are often the CEO, the CFO, the chief sales officer, the marketing officer, the accountant too. They wear a lot of hats. And so often what the playbook is to bring in support at the C-suite level. So that would include adding a CFO, giving them visibility on making budgets, giving them visibility on how to make better business decisions based on the data that's coming out of institutionalizing the kind of the tech, ERP systems, all those types of things. So getting the right people in there to support the next leg of growth. In addition to that, it might also come down to is putting a board in place, having individuals come on the board and bringing different levels of expertise. Maybe they're people that are from within industry that can help sit in a side seat along the CEO, along the private equity firm to make key business decisions, and also help evaluate or source deals too as well from an M&A perspective. When you think about other small add-on or tuck-in acquisitions that the business will be doing over a very critical time period of the next 3 to 5 years over the hold, those individuals play a key role in sort of vetting ideas too as well, in addition to the private equity firms as too. And then when you think about getting the business positioned correctly, with different add-on acquisitions too, you think about teeing the business up for appropriate exit, where you get that uplift in multiple too. After you've grown revenue, you've made the business a lot more profitable, maybe add a turn of leverage to it, positioning it right into a broader auction or traditional auction, where is often times where because the valuation discrepancy exists is because in the lower middle market, people are sourcing these deals off market or through proprietary processes, through regional banks, advisors, people that are close to the family members themselves. But in this case, where they have the actual know-how and knowledge to go through bank processes to attract a lot more buyers at scale. So these could also include strategics, or they could include other private equity firm sponsors as well. Further down too, you have sort of why it make the asset classes attractive. You also have the resilience in economic cycles, lower correlation to public markets. We mentioned less competition further down, less capital available to deploy in all these different businesses. 80% of all PE capital is concentrated in $1 billion plus funds, which is a pretty outstanding stat. Yeah. So creating that less competition for people to face, and then there's also the capital overhang too, particularly today with the large players as well. I think we have to also think about kind of the risk aspect of it too.
Yeah, right away. I mean, if you're thinking just of the nature of these businesses, succession planning, and just thinking if you're a family-owned business that's been run one way for a very long time, now private equity funding comes in here and says, hey, Jim, who's been running his own plumbing company for 35 years, here's a CFO from New York that has never turned a wrench before. Right. That person's receptivity to automation, to technology, to just a new face coming into the room can be a risk for sure.
Sure. And when you think about all the customer relationships that founders built over the years and years and years, and how close he is with those customers, and they're his biggest champions, and then having a new individual step in can definitely change the dynamics a little bit. But creating that cultural alignment is a huge piece.
Another risk too, I think some people don't really talk about, is if you are a founder of a business that you've been running for 20, 30 years, and then a private equity firm shows up and writes you a multi-million-dollar check, how incentivized are you to stay on board and provide strategic assistance to the private equity firm? Because while these firms obviously have a lot of operational expertise, this person knows the firm better than anyone else. So how incentivized are they to stay on board and work as hard as they have to grow the business to where it was after their bank account has a bunch of zeros after it?
It's an important point, but I think one of the mitigating factors there again is I think the right thought put in place up front to keeping the founder in place. I think some of the best returns or some of the best exits often come with when you keep the key management people in place, the culture the same. They're able to roll equity, which is an important point. So it does create that alignment there. And then obviously there's a lot of different ways to sort of skin the cat, if you will, on to creating this alignment, but everyone's different, everyone's unique. And so private equity, lower middle market private equity firms, creating kind of solutions for those individuals. So they're looking at a 3 to 5 year plan. So there is that alignment too, but it's an incredibly important point you make.
Yeah. Some other risks, right? And the operational inefficiencies. A few moments ago, we talked about that as, sort of low hanging fruit for private equity firm to come in. And if we're so close to the CRM industry, if we just think of that, for example, right? If you're running a sales organization using Excel, it seems like it would be very easy for a private equity firm to come in and say, hey, try using Salesforce, try using HubSpot, to just sort of, immediately organize that. The issue that becomes is, what if they're using nothing, right? If you're coming in theory, to evaluate a sales organization, you say, hey, walk me through your, revenue retention projections for November of 2025. And it's March of 25. And the founder who's been, servicing all of the customers, running the books, and handling the sales effort is like, I have no idea. Then you almost sort of don't know where to start. So while those operational inefficiencies can be low-hanging fruit, can be a benefit because it's such an easy thing to fix, can also lead to some headaches.
Sure. I don't know why the picture of dodgeball just came to my mind too. When he opens, I've got some receipts for you, and he opens up the door, and all those receipts pile out.
Yeah, exactly that. And then we obviously talked a lot there just about leadership gaps and talent retention. There's also the limited access to capital, just with traditional bank financing being difficult for a lot of these companies. Yeah,
when you think about it too, in the underwriting process, when you're evaluating a deal and its path to success and good outcomes, you have to get that scale factor too. The deal environment can change, financing environment can change when you're doing add-ons, and a lot of these firms that are operating this were very aggressive and creative from that standpoint. But if you don't get to that right proper scale that you hope to achieve, you won't necessarily always see that uplift in terms of the exit. I know Eden Capital is going to talk a little bit about sort of how to mitigate some of these aspects too, but there's a couple of different ways that groups are going about that. Alternative financing, operational enhancements, which we talked a little bit about, the talent development and scaling, and the recurring revenue models too, which is very attractive too. You've seen it in software, you've seen it in some other businesses too. You mentioned the plumbing business as an example. I mean, that is recurring revenue too. Yeah. And I think, firms over the years have really catch on to these other non-obvious industries that actually do have that type of revenue dynamic.
Yeah, the recurring revenue model is great. I don't need another subscription though, that's for sure. But let's hear from Eden Capital just on how they think about post-acquisition optimization.
Kind of moving on to post-acquisition. So just how hands-on Eden gets. You mentioned kind of reshaping the board and being able to add the add-on acquisition. So anything you would like to kind of touch on there?
So as you've heard through this conversation, we are active partners. I don't want the CEOs and operating partners out there who are hearing this that we're reaching over and taking over the steering wheel. We certainly are not doing that. They're driving the business, and ultimately it's their decision. But what's important is that they know that they have partners in the investment team and in the operating partners that are there on their side to help them. And because we've done this a number of times now, we have tools that they're not going to get to through this one experience. And so we can bring those tools to really help them accelerate the growth and the trajectory of the business. One interesting case study that we're live on right now is Intelvio. Intelvio, when we met them in 2023, was a business that was focused on phlebotomy training. In fact, their name was Phlebotomy Training Specialist. As we acquired other businesses, we rebranded because it was no longer just phlebotomy. We acquired other areas that we put under the same umbrella. So when we met that business, we saw an opportunity here to solve a major problem in the healthcare field. Did you know that the average age of healthcare workers is 54?
Wow.
The general population is in the mid 40s, so a lot older. And in the next 10 years, they're going to reach retirement age. So that's half of the healthcare worker population. We already have a shortage. So we're just going off a cliff here. On the other hand, you've got the aging US population that's requiring more healthcare services, right? And at the same time, you've got no one on the other end to provide those services, and that population is falling off into retirement. So we need to address this problem as a society, and we're not going to open a medical school at Eden. Right. But what we saw with phlebotomy that was really interesting is that we could at least make a dent on the allied health fields. So those fields that are more entry-level healthcare fields like phlebotomy that you can get working into in a couple of months and then help those folks scale. So IntelliView initially started in phlebotomy. We've now added 2 verticals organically that we've built with a chief learning officer that we brought, and 2 other verticals that we acquired in the last 18 to 20 months.
Great. So we talked a little bit about why this asset class is attractive. We talked about some of the risks. You just heard from Eden on their perspective on these risks and risk mitigation strategies. Now let's talk about the exit opportunities. So Chris, you went through some of this already, but obviously there's the ability to sell to a strategic, right? You have a larger industry player. That's a simple one. It sort of makes sense right away. You buy a small company, you sell it to one of their larger peers, right? That's pretty clear. Secondary buyout, we talked a little bit about that earlier. So that's where, these firms are sold to larger private equity firms. So pretty similar to that strategic, just sort of flipped on its head, where the private equity firm is offloading to another. Maybe that's something we saw earlier with the Thoma Bravo and Francisco situation. I'm not actually sure which one of those firms is larger, so don't come knocking down the door if you're either one of them. IPO, obviously this is going to be rare in lower middle market in general, even more rare today. We could probably do a whole segment on the current IPO market.
Yeah.
But that's going to be a little more difficult, but could still happen. And then finally, a management buyout. So this would be where the firm sells the equity back to the management.
Yeah, definitely a unique case. You don't see this all the time, but sometimes you need capital at a critical point to kind of get that business to the next leg of growth. But they create a mechanism for the management to buy back in. And now that the business has been set on its course, it's a nice outcome to keep the business in the hands of that individual too. But strategic sales definitely, double underline that. That is the core outcome. That's like a big focus. It's not necessary. Obviously, there's sponsor-backed transactions, but when you think about some of the larger peers that are very acquisitive, these lower middle market buyout firms are really getting these businesses to scale and doing the big heavy lift, the basic blocking, tackling, so these firms can integrate well on the back end for those firms.
We'll close out this segment. Alex, you're going to walk us through some lower middle market buyout funds that are in the market. Obviously, we've talked a little about Eden. Maybe you can add some color there and talk Crest Rock and Revelstoke.
Yeah, for sure. Definitely just want to just close out that discussion we just had. I think overall, it's clear that the return potential of lower middle market buyout is very immense, but it comes with some work as well. When I think about like venture capital, for example, where you're just trying to get shots on goal and throw as many darts on the board as possible. With lower middle market, it is a very hands-on investing approach where once you acquire a company, we've heard it from Eden, we've talked about it, you really need to be hands-on, hand-holding, making sure that you are working with these companies very closely to make sure that these operational efficiencies, these technological improvements actually take place and advance the business forward. So again, while the returns can be really high, you have to really roll up your sleeves and get the work done. With that said, there's some firms in the market right now with some lower middle market buyout funds. One obviously is Eden Capital that we've heard from previously on this podcast. So again, lower middle market focus, looking in control investments in technology, business services, and education. One of their previous portfolio company, which we talked about a few weeks ago, is Wall Street Prep, which they sold to Riverside. It's just an example of the type of companies that they invest in. For this second fund, they're targeting around $300 million, which is a pretty significant step up from their first fund. So when they think about the type of companies that they're investing in, they really want to prioritize scalable, profitable businesses in sectors with non-discretionary demand and leveraging that value creation playbook that they spoke to. In terms of sort of quantitative figures, they're looking at companies with enterprise values up to 150 million, with an EBITDA ranging around 3 to 15 million. Geographically speaking, they're looking mainly in the US, but also in Canada and Western Europe. Another firm to call out is CrestRock. They are raising their second fund. They focus on low middle market companies and businesses undergoing a lot of transformation. So they try to really collaborate closely with management teams to drive value creation through, again, the things we talked about: performance optimization, operational improvements, things of that nature. Similar EV ranges and EBITDA ranges to Eden Capital, looking at $6 to $25 million of EBITDA and enterprise value from 15 up to 150 million.
And it looks like too, you mentioned them focusing on businesses in transition too. Maybe it's a new product, maybe they're under earning from a profitability perspective too. So I think their EBITDA ranges can go down to, negative 6 million or something like that to 25 million. So unprofitable businesses too that are well on their way to becoming profitable. So they're willing to take that risk and buy into businesses going through those transitions too. And probably obviously have to be compensated as well for the risk.
Higher risk investments.
And these are software and technology, IT, business services, industrial manufacturing. So probably, in that technology space where you'll see, businesses that might be under earning, and there's ability to put a, right size the cost structure, grow revenues faster, and just kind of earn into that profitability.
Exactly. And then one more to call out, Revelstoke. They are in the market for their fourth fund. They are focused on healthcare and business services companies in the US, mainly making buyout investments, but will also invest in significant minority investments if it makes sense for them. They try to partner with founder-led businesses and really want to be the first institutional capital in to provide that operational expertise at the onset. Some of the subsectors that they focus on: value-based care, behavioral health, home care, and health and wellness, and really looking at businesses that drive cost reduction and improve patient outcomes. And then just putting some numbers around it, they're looking at companies with EBITDA from $5 to $75 million, so sort of a broader range than the previous two, and looking to scale those companies through organic growth as well as inorganic growth.
I think, that's a couple examples are, both Revelstoke being a healthcare specialist, so very focused in one particular sector. And then we have two other examples, both Eden Capital and CrestRock Fund, being, kind of on the more diversified side, but also concentrated when you think about portfolio companies, between probably 6 to 12 portfolio companies for those examples as well. We've got a couple other funds I think we're going to check out too, Pat.
Yeah, we're going to move away now from low middle market buyout and just get to funds in the market. We'll touch on that Hamilton Lane Secondaries Evergreen Fund. We talked briefly about this last week. More information has come out, so I'll just read this off here, and then Chris, why don't you wrap us up?
Sure.
But Hamilton Lane, like we teased last week, announced the launch of a secondaries-focused evergreen fund for accredited investors in the U.S. It is set at a $1 billion maximum offering in a prospectus that was filed on February 28th, just a few short days ago. Through the Hamilton Lane Private Secondary Fund, the private markets manager will target opportunities in middle market buyout funds and assets, prioritizing opportunities for both entry discounts and long-term appreciation. It's going to be traditional LP secondaries as well as GP-led secondaries. The minimum investment for the fund is $25,000, and the opportunity for liquidity will be offered quarterly for Class R, Class I, and Class Y shares, with R shares subject to a 3.5% maximum sales load. In their history, Hamilton Lane has been a leader in secondaries for over 24 years. They have committed over $20 billion across more than 405 transactions. So excited to see how they'll continue that.
This is an interesting strategy because it combines two things we spoke about on previous podcasts. You have the evergreen structure, sort of quasi-liquid fund structure, paired with the secondaries asset class. So looking at this evergreen secondaries product, this is like right up the fairway with a high net worth RIA family office channel that is looking to dip their toes into the alternative space, getting a broad, diverse exposure through secondaries, but also having the ability to get in and out of these investments with the sort of liquidity component with the evergreen structure.
Absolutely. You think about a firm like Hamilton Lane too. They've managed assets on behalf of the largest institutions globally. They have visibility into private equity funds, the developments, the progressions of portfolio companies, and when you think about their ability to leverage that data and underwrite secondary transactions and then invest in those secondary investments, it's definitely an edge to keep an eye out for. So more to come there. It's a new product for the firm, but secondaries has obviously been a long-standing part of their business too. So transitioning to Accolade Partners, this is a new fund of funds that actually just launched. They filed their Form D with the SEC. The Washington, D.C. based alternative investment firm listed Accolade Partners Growth 4, Accolade Partners Venture 2, Accolade Partners 10, and Accolade Empowerment Fund 2. These come on the back of their prior funds that they raised for those strategies. In the earlier iterations of this fund of fund series, Accolade teamed up with some notable investors, including the Montana Board of Investments, City of Annapolis Police and Fire Retirement Plan, City of Lakeland Retirement System, Marion County Community Foundation, to name a few. The firm did not disclose a target for these new funds, but it indicated it expects each fund of funds to be open for subscription for more than a year. So for investors looking for tailored solutions through a fund of funds approach, where they're not necessarily doing direct private equity funds themselves, this might be a firm to check out. They target private equity growth opportunities through its Partners Growth Fund and venture capital opportunities through its Partners Venture Series. Through its partner funds, the firm invests in a combination of private equity growth and venture capital, while through its empowerment funds, it targets emerging venture capital and growth equity managers deemed underrepresented in the industry. So including those run by minority and female managers. The firm focuses on technology and healthcare sectors. In addition to strategies represented by the new funds, Accolade will also invest in blockchain fund investments too. So some growing segments of the market that they're targeting with these funds.
Accolade, Washington, D.C. based, as you mentioned. We don't have one on the calendar just yet, but we will be hosting a Washington, D.C. based Dakota Cocktails event this year, which we're very excited about. We did it some time ago, and I attended, and I'm not kidding, it was the worst weather of any place I've ever been in my life. You would have thought we were on top of Mount Everest. It was like raining nails. But the weather's going to be great at all the rest of our locations. I called ahead and made sure. So we will be in Park City on March 20th at the Spur Bar and Grill. Come straight from the slopes. We certainly will be. Atlanta on March 26th. That one will be very exciting as well. We've not been to Atlanta in 2 years, so we're excited to make our return. New York City, we're back on April 8th. San Francisco on April 9th. We will be in London on June 11th.
Are you going to London?
I am not sure, because the week before I'll be in Berlin for Super Return. We are hosting a sort of surprise event for that. If you're still listening to this podcast, you get to register first. So just shoot us a note and we'll make sure that you're registered for
sneak peek. Sorry.
Berlin Super Return. No, all good. We're going to get the word out soon. But yeah, we'll be doing an event in Berlin around Super Return. I'll definitely be there. I'll probably stay and just go straight to London. A little Euro summer. Why not? 2 weeks, start June. And then, Chris, tell us about the Dakota Research Conference.
Yeah, so Dakota Research Conference, we've mentioned this on prior episodes. This will be June 17th at the New York Athletic Club in the afternoon. We're super excited to have this event. This will be geared towards general partners presenting to limited partners. So we have an amazing lineup of firms speaking at this event. It'll be an opportunity to learn about investment strategies, get key actual insights, takeaways, meet the people behind the firms, and then networking too with your peers. So more to come there. We're going to post some more things about that event coming up with the details, et cetera, sign up website. But we're very excited on our team about that event and more to come.
Great. I think that wraps it up for us today, gents. It was a fun one. Lower middle market, good stuff.
Next week, we're going to be talking about energy.
Energy next week.
We talked a little bit about it earlier today. We've got an exciting interview that we're going to present there too as well. So look forward to discussing energy and all that's going on within that market.
Great. Thanks everyone for listening in. We'll be sure to wear green next week for St. Patrick's Day.
There you go.
Hello everyone. Thank you so much for listening to the Private Fund News live show. All of the information we covered today and much more lives in Dakota Research, our private fund due diligence database. If you're not familiar with Dakota Research, we really encourage you to go onto our website and book a demo so you can check out all of the recordings, all of the data and information we covered, and much, much more. Again, thank you so much for listening in today. Go to our website and book a demo of Dakota Research today. Thanks.